Markets rebounding sharply yesterday following the temporary trade truce between the U.S. and China. Our next guest is raising his year-end target on the S&P 500 to 6,400 from 6,000 and reducing his odds of a recession this year. Joining us right now is Ed Yardeni, president of Yardeni Research. So let me ask it to you this way, Ed.
Sure.
Is this some form of vindication for Powell waiting thus far?
Well, absolutely. I was not expecting that there would be a Fed rate cut this year, and I still think that because the U.S. economy is very resilient. The consumer hung in there extremely well over the past 3 years when the Fed raised interest rates, and now the consumers held up, I think, quite well with the tariff uncertainty and capital spending. For all the concerns that uncertainty would put a hammer to capital spending, the reality is technology capital spending, which now accounts for over 50% of total capital spending, remains very strong.
So maybe it's a counterfactual. Could you say it's a win in the Jay Powell camp, but maybe also a win in the Trump camp in that the economy has held up, I think, a lot better than had been expected? Right. I don't know if you read, I think he's a good friend of yours or a friend of yours over the years. You've read him. Greg Ip had a piece in the Wall Street Journal this morning saying, you know, the outcome of what took place yesterday might be where you want to be. How we got there might not be how you want to get there. Having said that, it also appears that this economy has been so strong in some ways that we've managed to get there despite all of that. Meaning, what would have happened had we not been approaching these tariffs this way?
Andrew, I've been doing this for a few years, and one of the things I've concluded is that it's amazing how well the U.S. economy and stock market do despite Washington. So we're all paying a lot of attention to the headline news on Washington. You folks do a great job of covering the political developments and the economic developments coming out of the Beltway. But the reality is the rest of us working stiffs do a really good job of keeping the economy moving forward and figuring out how to live with the government's meddling.
In terms of CPI, what's your expectation?
I think the headline will be 0.2. I'm expecting to see some moderating impact from energy prices. And at the same time, if you look at core, I would expect to see 0.3. But even if it turns out to be hotter than expected, I think the market will attribute it to the tariff situation. We know that used car prices, for example, jumped in April. And that probably had to do with the 25% tariff on imported cars having an impact on the entire auto industry. So I think the market would look. I think the market's already looking at 2026. I think the market's concluded enough of this noise. Let's see where we're probably going to get signal and good signal, and that'll be later this year into 2026.
So we don't need to worry about no one ever buying a treasury again, or a capital flight out of the U.S. or none of that happened.
Yeah.
Or do we see it? Or do we see it? Remember the last jobs number? We said this would be a big jobs number, unless it's not. And the next one is a big. Are we never going to see any of the adverse effects of the uncertainty? I thought small businesses were closing and.
Look, I think there's a lot of scary stories about what tariffs would do. And certainly if the president hadn't postponed the tariffs and basically changed his mind, I think we would have some problems. With regards to your question on the dollar, the U.S. is the largest capital market in the world. There's nothing like it. Sure, we've got a lot of debt, but people have been buying that debt because they do want treasuries. So no, look, the worst that can happen in the treasury market, as we saw in 2023, is yields go up to levels at which people want to buy them. And they got up to 5%. People wanted to buy them. And before you know it, the yield came right back down.
I mean, weren't you at 7,000, Ed?
Yeah.
It got you to go to 6,000.
Sure. And now back to 6,500. I think Andrew's
whipsawed.
Well, I don't look at it that way. I've written that I reserve the right to change my mind about
based on putting them on, taking them off. Yeah, putting them on.
Yeah, it's been.
Can we say this? You think China was much more affected than we were? Do you think that's one of the reasons that it's paused? Or?
Well, this is it's such a short time in which all this happened, so I don't know that there was any immediate consequences, but I think there was a recognition in China that it would hurt and hurt badly, and so they reciprocated in a hostile fashion to Trump's tariffs. I think everybody decided that this is not a good issue to have prolonged. I think this administration wanted to get this tariff issue behind them by the middle of the summer, and it looks like they're doing it ahead of schedule.
The 30%, do you anticipate that staying, or you think it's your 6,500 kind of has that falling to 10%, the basic floor that Treasury Secretary Bessent has laid out?
Well, look, I think we are going to 10%. I think Trump wants to declare a victory that tariffs are good, and a 10% tariff is already generating, in April, it generated customs duties that were almost at a $200 billion annual rate. So that helps. This administration needs to find ways to generate more revenues and slow down the pace of outlays. Everybody knows that the federal deficit is not on a sustainable path. So I think at the end of the day, we are going to see that the minimum tariff is 10%. In some cases, that could be eliminated if we're happy with the deal that the other side brings to the table.